Reported net profit is up 42%, but actual free cash flow has plunged to negative $96 million. Something here simply does not add up. I have been tracking CSE Global for a while now, and the numbers in this latest report made me run the data twice because the gap between reported profit and cold cash is stunning. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living of a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Turning to the market's reaction, the sell side is looking at this engineering business with massive optimism, focusing entirely on a full order book. But a forensic review looks at the other side of the ledger, because while the order book is packed, the bank account is emptying out fast. We are dealing with two completely different stories here. On one side, you have a reported net profit up 42%, hitting $37.5 million. But on the other side, free cash flow is negative $96 million. That is a massive $104 million gap. And the entire income narrative falls apart the moment you move away from accounting entries and look at actual cash. Let's see who this analysis is actually built for. If you look at KGI Securities, they have a buy rating with a target price of $1.45, while the 5 analyst consensus stands even higher at $1.95. This is a framework designed for growth investors who have a multi-year runway and a very high tolerance for balance sheet turbulence. But this review is not built for that type of investor. This review is built specifically for the retirement investor. If you are 5 to 10 years away from retirement, or if you are already in it managing your CPF and SRS capital, you absolutely cannot afford a structural write-down. When the headline order book and the cash flow reality tell completely different stories, you need a framework that reads the cash story. Our forensic mission today is straightforward. We are looking past the marketing narratives to answer the hard questions that institutional money takes for granted. Can the earnings actually cover debt costs? How much leverage is sitting on the books? And most importantly, is that reported net profit backed up by real, verifiable cash inside the bank account? To be completely fair, let's look at the institutional growth thesis. First quarter of 2026 order intakes surged about 75% year-on-year, giving strong forward revenue visibility. Second, the global data center build-out and industrial electrification provide a structural multi-year revenue runway. And third, reported net profit rose 42% to $37.5 million, with diluted earnings per share at 5.3 cents. KGI expects a 12 to 24-month re-rating as these orders convert. But here is where the forensic gap appears. While the market targets sit at $1.45 and $1.95, Investing Pro's fair value model, which aggregates 15 independent methodologies, places the average fair value at just 99 cents. That means the stock is trading at a 32.3% premium to its forensic fair value estimate, and that gap is filled entirely by management assumptions rather than verified cash flows. Looking at our first dimension of valuation, the market is pricing this stock at 25.3 times trailing earnings, assuming continued profit growth. But the forensic counter reveals that operating cash flow is negative $67 million against that $37.5 million in reported profit. Applying a price to earnings multiple to non-cash profit is not a true valuation. It is a speculative projection built on a foundation that has not actually appeared in the bank account. When you buy this stock at the current price of $1.31, you are paying a 32.3% premium over forensic fair value, while the business is actively burning $96 million in negative free cash flow. For a retirement portfolio, this is no longer a stable income position. It is a highly speculative bet on operational recovery. Moving to our second dimension of income, the trailing dividend yield sits at a tiny 2.0%. This yield fails every single forensic hurdle. It is 270 basis points short of my personal 4.7% minimum hurdle. It fails the absolute forensic floor of 3.2%, and it even fails to beat the guaranteed CPF ordinary account rate of 2.5%. The income story gets worse when you look at how the full year 2025 dividend of 2.6 cents per share was actually funded. Free cash flow was negative $96 million, while the company raised $103 million in net new debt over the exact same period. That means the distribution was paid entirely out of borrowed money. Let's be completely honest. A dividend paid from borrowed capital is not true income. It is simply a liability dressed up as a yield. Management is also running an active scrip dividend scheme, offering new paper shares instead of cash to defend their balance sheet, which dilutes existing holders. And remember, the 4.7% hurdle still applies because open market risks like gearing and permanent capital loss do not get cheaper just because your CPF options are full. This is a structural verdict, not a short-term timing signal. At 2.0%, this stock fundamentally fails the absolute forensic floor regardless of what the share price does. Until free cash flow swings positive and the dividend is fully covered by core operations rather than new bank debt, the income case for a retirement portfolio simply does not exist. Now let's apply our 3-pass cash flow audit under execution risk. Pass 1 shows net profit up 42% to $37.5 million. But Pass 2 shows operating cash flow swung a massive $100 million negative to negative $67.2 million. Pass 3 leaves free cash flow at negative $96 million. The driver of this total collapse is working capital, with $92.8 million locked up in physical inventories and $188.8 million sitting in contract assets. What exactly is a contract asset? This is revenue recognized for work completed but not yet billed or collected. Think of it like a hawker who served hundreds of customers, but everyone wrote an IOU notebook promise instead of paying cash. Your record notebook shows a fantastic profit, but your cash drawer is completely empty and you have to borrow money just to buy tomorrow's supplies. When $188 million sits as unbilled promises, accounting profit rises while the bank account empties. Because the cash drawer is empty, debt is rising while coverage is falling. Total borrowing spiked from $155 million to $265 million, adding $110 million in a single year, while the interest coverage ratio of 6.0 times passes the 4.0 floor, and net debt to EBITDA at 3.2 times passes the yellow flag threshold. The trajectory is worsening rapidly and warrants extreme monitoring. Moving to our 4th dimension of ownership signals, on the 2nd of June 2026, lead independent director Ken Chang Kong resigned from the board. The stated reason was highly explicit: differences of views with regard to working with controlling shareholders. The independent director's specific job is to protect minority shareholders, and this resignation signals that the primary internal check on power has completely broken down. This governance gap is happening at the worst possible moment. The vacancy is for the chair of the Audit and Risk Committee, which remains empty as of the 13th of June 2026. Meanwhile, a formal strategic review is active after Heliconia Capital, which holds a 23.79% stake, initiated it on the 5th of March 2026. Major corporate adjustments like a full privatization, stake sale, or asset spin-offs are actively on the table. We also have serious structural tensions for minority shareholders. Board Chairman Tan Teck Koon also chairs Heliconia Capital, creating an overlapping interest. While the public float holds a meaningful 53 to 57% collective voting weight in any scheme of arrangement, you are voting without independent audit and risk committee oversight. Furthermore, the shareholder yield is negative 10.6%, confirming that the company is net extracting value through dilution rather than returning it. Before we head directly into the final verdict, let's take a quick moment. You are not tuning in for standard copy tips or market hype. You are here because you want the unvarnished forensic truth before you risk a single dollar of your hard-earned capital. That tells me you take your portfolio preservation seriously. But here is the reality of running an independent platform. The YouTube algorithm doesn't know you check the gearing ratio twice or spend hours reading data. It only measures one clear signal, and that is whether you have clicked that subscribe button. If this analysis has ever helped you spot a risk or protect your savings, please subscribe and share it with someone who needs it, to show the machine that data-driven SGX analysis deserves a seat at the table. Looking at our 5th dimension of target alignment, the institutional buy case isn't wrong within its own framework. If you are a growth investor with a 5-year runway, strong conviction in data center electrification, and a high tolerance for balance sheet volatility, the order intake momentum provides a reasonable foundation. But retirement capital operates under a completely different mandate that cannot absorb structural write-downs. This is simply the wrong framework for retirement capital. Here is the full summary of the risk profile that retirement capital simply cannot afford to absorb. You have a 2.0% yield sitting below the absolute forensic floor, negative $96 million in free cash flow with a dividend funded by debt, a major governance gap during an active strategic review, and a 32.3% valuation premium. In a retirement portfolio, not yet is never a forensic pass. It is a clear red zone flag. Let's pull up the comprehensive financial health checklist to see how the metrics stand against our institutional baselines. While the debt and leverage numbers technically pass the safety ceiling thresholds for now, the critical income, cash flow, and valuation metrics are triggering severe failures across the board, landing this stock into our highest risk zone. To break down the active soft flags, Flag 1 is a dividend paid entirely from debt while free cash flow is deeply negative. Flag 2 is a massive $100 million cash reversal in a single year. Flag 3 is rising gearing, with total debt up $110 million. And Flag 4 is a major valuation premium, with the stock trading 32.3% above its investing pro-forensic fair value estimate. Looking closely at the dividend trajectory, the distribution per share fell from 2.75 cents in 2023 and 2024, down to 2.6 cents in 2025, losing its operational cash coverage. Also, please remember that my 3.2% forensic floor is a static standard calibrated for long-term average interest rates, ensuring our analysis isn't distorted by temporarily depressed T-bill yields. Applying our zone gate, the suitability metrics show a clear failure for accumulation, transition, and drawdown roles. This stock is strictly limited to a speculative growth role only, placing it squarely within Zone 5, the red zone. Why is this Zone 5 assignment completely unambiguous? The hard gate failure is immediate. The trailing yield of 2.0% falls below our 3.2% absolute forensic floor, triggering a Zone 5 classification regardless of any other metric. The supporting balance sheet safety metrics pass on paper, but all three are deteriorating as debt increases to fund a cash-burning operation. The governance dimension adds a critical risk layer that numbers alone cannot capture. Having an empty audit and risk committee chair seat during an active, controlling shareholder strategic review is a severe institutional protection failure. Any serious retirement investor should treat this vacancy as a strict disqualifying condition until it is fully resolved. Let's deliver a critical insight on the scrip dividend scheme. When a company hands you paper shares instead of cash, they are defending their remaining cash balance by diluting you. The distribution has already fallen to 2.6 cents, and even that is borrowed. With a shareholder yield at negative 10.6%, this is a classic yield trap where the dividend cannot be sustained by core cash generation, making that dividend column a mere assumption rather than a promise. Our second major insight focuses on the governance gap. The committee responsible for reviewing related party transactions and safeguarding your minority interests has no independent leader at the exact moment a 23.79% stakeholder is exploring privatization and asset sales. While your 53 to 57% public float holds structural voting power without independent oversight is incredibly weak. Capital preservation requires standing aside until this vacancy is properly filled. What does all of this mean for you at the end of the day? The data center electrification thesis is entirely real, and the order book is real. This framework is not dismissing the underlying engineering business. However, at the current price of $1.31, the market simply does not compensate a retirement investor for taking on negative free cash flow, a debt-funded dividend, a governance vacuum, and a 32.3% valuation premium. Before even considering this stock for an income portfolio, there are three strict conditions you must monitor. First, does the new ARC chair appointment have zero prior ties to Heliconia Capital or the controlling block? Second, does free cash flow turn positive in the August 6, 2026 results, proving contract assets are converting to cash? And third, do the strategic review terms reflect fair value relative to our forensic range? Do not chase a recovery narrative until the cash flow confirms it. To summarize the forensic stakes today, we are seeing a clear divergence where structural tailwinds cannot mask severe cash flow and governance deficits. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. If you want to protect your capital from structural yield traps and see the warning signs well before the standard 7-day public release window closes, join Iggy's elite investors. For just 9 Singapore dollars a month, you get full 0-day access on Substack and YouTube, my comprehensive red zone watch list, and institutional grade cheat sheets to keep your retirement capital safe. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Stocks flagged as Growth Watch fall below this threshold but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, Please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds. Lubarino.